Are you dreaming of pulling in profits before the closing bell? Of riding those microwaves of market movement to financial freedom? The allure of day trading is powerful, promising quick gains and a fast track to wealth. But beneath the surface of this high-octane world lies a harsh reality. Most who step into the arena of day trading end up battered and bruised, their capital vanishing faster than a flash crash. Why? What makes this seemingly simple concept, buy low, sell high, within the same day, so treacherous for the everyday investor? This is Finance 101, simplifying finance one concept at a time. And in this video, we are here to pull back the curtain and lay bare the fundamentals of day trading. We'll explore what it truly takes, the hidden traps, and whether you have what it takes to even play this high-stakes game. So, what exactly is day trading? Simply put, it's a fast-paced form of investing where you buy and sell securities within the same trading day. The goal? To profit from those rapid, short-term price fluctuations in everything from stocks and options to currencies and futures. Why do people do it? The attraction is obvious, the potential for quick profits. Day traders aim to capitalize on perceived market inefficiencies using various techniques and strategies. Think of it like catching small waves throughout the day, rather than waiting for a big, long-term swell. Who are these nimble market surfers? They range from professional traders working for large financial institutions with sophisticated tech and vast resources to individual traders trying to make a go of it on their own. How do they operate? Unlike long-term investors focused on a company's fundamental value, day traders are laser-focused on immediate gains from price movements. They use tools like real-time market data, sophisticated charting platforms, and high-speed internet to identify potential entry and exit points based on technical analysis, looking at past price patterns to predict future trends, and momentum trading, riding those short-term waves. Sounds exciting, right? But here's where the first major hurdle slams into view: regulation. In the US, if you're labelled a pattern day trader, meaning you execute 4 or more day trades within 5 business days, making up more than 6% of your trading activity in that period, and you use a margin account, you're hit with the $25,000 rule. You must maintain a minimum account balance of $25,000 just to keep playing the game. Day trading too much? You might need $25,000 just to keep trading. So, imagine you're trying to actively trade multiple times a week. If you exceed a certain threshold of day trades and you're using borrowed money, margin, the regulators step in. They want to ensure you have enough capital to withstand the potential losses inherent in this rapid-fire trading style. Imagine you're playing a fast-paced game with borrowed toys. If you play too many rounds too quickly, the grown-ups want to make sure you have enough of your own toys to cover it if some of the borrowed ones get broken. That $25,000 is like having enough of your own toys. To even have a fighting chance, you need the right arsenal. Forget leisurely checking your phone. Day trading demands serious tools. We're talking about access to real-time market data feeds, sophisticated charting platforms that can identify patterns automatically, and blazing fast internet connections. Some even use software that integrates directly with their brokers for instant order execution. For the big players, those working for institutions, they might even have access to a trading desk, providing instantaneous order execution, a crucial edge when news breaks. They are the sharks in the water, often capitalizing on opportunities before individual traders can even react. And speaking of sharks, let's talk about the unseen antagonist in this story: high-frequency trading, HFT algorithms. These super-fast computer programs can execute trades in microseconds, exploiting tiny price differences that are invisible to the human eye. They are the silent, relentless competitors that individual day traders are constantly up against. Think you can outsmart the market with a hunch? Think again. You're not just competing against seasoned professionals, you're battling lightning-fast computers designed to profit from the smallest of edges. Consider the infrastructure advantage. Institutional traders and HFT firms invest heavily in co-location services, placing their servers right next to exchange servers to shave off milliseconds in trade execution. For an individual trader relying on a home internet connection, that's a significant disadvantage in capturing fleeting opportunities. Imagine you're in a race. The professional racers have super-fast cars that can zoom ahead in the blink of an eye. You're on a regular bicycle. Even if you know the track well, their speed gives them a huge advantage in getting to the finish line first. The HFT algorithms are like those super-fast cars in the stock market race. Despite these challenges, some individuals attempt to carve out a niche. They employ various day trading strategies, including scalping, aiming for many small profits on tiny price changes; range swing trading, using price support and resistance levels to make buy and sell decisions; news-based trading, capitalizing on the volatility around news announcements. They rely heavily on technical analysis, studying charts and patterns to predict future price movements. But remember, even the most intricate chart patterns can be deceiving without a deep understanding of the market. Now, let's talk about the elephant in the room: risk. The SEC itself warns that day traders typically suffer severe losses in their first months, and many never profit. You are essentially betting on short-term price swings, and those swings can go against you with brutal speed and force. Many day trading strategies involve leverage, using borrowed funds to amplify potential profits, but this magnifies potential losses just as dramatically. Day trading isn't a get-rich-quick scheme. Most lose money. Period. The inherent volatility of short-term price action combined with the use of margin creates a high-risk environment. A small adverse movement in the price of an asset can lead to significant losses, potentially exceeding your initial investment. Margin calls can force you to sell at unfavorable prices, further compounding losses. Imagine riding a very fast roller coaster with no safety harness. You might get a thrilling ride and go up high, but if it suddenly drops, you could fall very far and get hurt. Using borrowed money in day trading is like taking away that safety harness. The ups can be higher, but the downs can be much, much worse. The dream of easy profits often clashes violently with reality. Studies consistently show that the vast majority of day traders lose money. Some put the number of those who profit consistently at less than 15%. While a tiny fraction might achieve significant earnings, most struggle to even match minimum wage when you factor in the time invested and capital risked. Beyond the financial risks, day trading demands intense focus, quick decision-making, and the ability to remain calm under pressure. You need to constantly monitor multiple data streams, interpret complex market signals, and execute trades with precision timing. It's a highly stressful, full-time job that blends analysis, psychology, and rapid-fire action. And you absolutely must learn trading discipline, sticking to your predefined criteria and avoiding emotional decisions. Day trading isn't just about numbers, it's a mental marathon. Stay cool. The psychological aspect of day trading is crucial. The constant pressure of making rapid decisions with real money on the line can lead to emotional trading, deviating from established strategies, and chasing losses. Maintaining objectivity and discipline in the face of market volatility is a significant challenge. Imagine you're playing a game where the rules change very quickly and you have to make decisions in a split second. If you get scared or too excited, you might make silly mistakes and lose. Day trading is like that game. You need to stay calm and stick to your plan, even when things get wild. So after all this, should you start day trading? The truth, based on the evidence, is stark. For most individuals, especially inexperienced traders without significant capital and a deep understanding of the markets, it's a very risky endeavour, with a low probability of success. If you're still determined, you need to gain significant market knowledge, have enough risk capital you can afford to lose, and develop strict trading discipline. Start small, practice, and be prepared for the very real possibility of financial losses. Day trading can be profitable, but it's far from a guaranteed path to riches. It demands exceptional skill, discipline, and a considerable amount of luck. Before you jump into this high-stakes arena, be honest with yourself about your resources, your knowledge, and your risk tolerance. For most, a more diversified long-term investment strategy remains a far more reliable path to financial growth. If you found value in this video and wish to deepen your understanding of financial principles, we encourage you to subscribe to our newsletter. Each day, we will deliver concise financial insights directly to your inbox, designed to be easily digestible and immediately applicable. Subscribers will also receive curated video recommendations, supporting consistent and continuous learning in finance. Simply click the link in the description below to subscribe and further your financial education. Thank you for watching. Stay informed, invest wisely, and we look forward to seeing you in the next video.